It turned out to be a relatively boring day today after a couple of weeks of quite a bit on the radar, from earnings to economic news and the Fed and minutes and all sorts of things. Today was very, very quiet. It's like the market had another 4-day holiday this week just to take a breather. Very small range, very low volume, and that's okay, right? We didn't necessarily follow through on last week's very strong into the week. But we also haven't broken through into the gap of that Thursday morning either. So far, so good from that perspective. We'll take a look at what that means. What's driving today's action. There was a pretty clear breakdown in one of our Magnificent Seven stocks. We'll take a look at that. We'll see what implication that's had on some of the other bigger sectors that are really important to market leadership in terms of risk appetite. And we'll see if there continues to be any kind of movement in those asset classes that really are driving risk appetite or not, specifically in the bond market and in the currency market, as well as with commodities. So crude oil really kind of, and in a very important level where it could break out one way or the other, could have some significant ramifications on inflation expectations, which of course have implications on yields themselves, and as we've seen after that, into the stock market. And then our trade idea is a stock that's in kind of a forgotten sector, a forgotten industry. It doesn't really get in the news too much, but nice, good breakout on this stock here today. So we'll talk about how to trade that going into a new options expiration cycle for most of our swing trades. So let's go ahead and get started. Today is Monday, February the 26th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video over here where I review all the old Market Outlook trades to see whether we should stay in them or not. I think we actually closed out a couple of them today, right before the market closed, and we also put on today's trade today already before the market closed as well. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do like this day in and day out. Those who don't, you can do it right now while you're watching. Our goal, as always, is to try to get these likes up to at least 100. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, a down day today, a first down day in after 3 up days in a row. I did bring the momentum line down to extreme lows. Again, that's just a function of just how small the ranges have been the last couple of days. Friday, the range was over 29.5 points. Today, the range was under 29 points. The average, again, is at over 46.5. So that's the reason why your momentum line is dropping. It is extreme because it's below the 5th percentile. It's actually below the 1st percentile. It's actually below the 0.5% of 1 percentile. So it's extremely low. Again, that doesn't really matter nearly as much if the near-term line doesn't get there too. I mean, it's kind of like this one over here where it got to an extreme low without the near-term line, and then it bounced back up. Now, there's been some other times. Here's another one where it got down to extreme low again without the near-term line. Both these instances, the near-term line was at least at the midpoint of the chart, if not below it. The near-term line is actually still in the reversal zone. Over here, this is where we were actually a little closer. I mean, the intermediate line actually did get below market sentiment and below the 80th percentile here. So, that's the kind of short-term sentiment we really would like to avoid, because that typically starts the intermediate decline when you have those kind of moves. So, but as of right now, I think we're okay. The intermediate line is rising, barely, but it's rising. It's above market sentiment. Both of those lines are well into the reversal zone. So I don't think we have too much cause for concern. We do have a bullish near-term peak here because it did get above the, into upper reversal zone. It didn't stay in the reversal zone for very long, so it's a pretty short move there. It'd be better if it was a little bit longer. We'll see if it stays, if it can bounce back up, as early as tomorrow and really kind of keep the near-term line in the reversal zone, because that would also be relatively bearish if we don't stay in the near term only, right? Not like we're going to tank tomorrow. But it wouldn't be bullish if the near-term line were to drop back out of the reversal zone that quick, or bullish territory, excuse me, that quickly. So this is something to keep an eye on here for tomorrow. Of course, your NASDAQ, Google being the biggest loser, but we'll see that in just a second. Your NASDAQ still dropping its momentum line also. Again, mainly just a function of how small the range has been. If you look at today's range, it was way below average. And then, again, last Friday's range was 188 points. So, I mean, really, really small range, bringing that momentum line down to just below the 5th percentile. The near-term line also coming down again out of the reversal zone, but still in bullish territory. Your intermediate line is rising, but it happens to be still below market sentiment, so not the most bullish there. Looking at the Dow Jones Industrial Average, you can see the intermediate line has crossed back above the market sentiment line. The near-term line doing the same thing, just not as low, and the momentum line, is below the 5th percentile as well. Again, but more a function of how small the range has been, not that we're tanking here. Your Russell 2000 is a little bit of a different story. The Russell 2000 actually finished up 0.5% today, continuing to fill in this gap here. The near-term line stayed a second day in the upper reversal zone. The intermediate line and market sentiment line are both still falling, and the market sentiment still actually intermediate line still below market sentiment. And again, your near-term line made it to the reversal zone. Unlike the other indexes, where the momentum line popped up and so did the near-term line, the momentum line did not pop up here, and the near-term line did. So again, that makes it less likely the near-term line can stay up there without the momentum line even getting into the upper half of the chart. It's actually, even today, still below the lower half. It's still below the 50th percentile. So interesting patterns to say the least. This is coming off of weekly patterns where you can see short-term sentiment is pulling back a little bit on the Russell. On the S&P 500, you're still very strongly bullish. I mean, we're still, you're not in a cluster mode, but you're still in the 87th percentile of how far you are above the 30-week moving average. The intermediate line's way above market sentiment. Market sentiment now this week is crossing above the 80th percentile. So that's about as strong of a bullish trend as you could possibly get there. Let's take a look at the other weekly charts here. Again, you can see a nice, good, a little bit of a long upper shadow. Not too big, but longer than what we've seen. If I were to add on, let's see here. I got a study where I've normalized out the size of the candles. You can see all during this bullish run, it's about the same size as what we got over here. The size of that long upper shadow. The body was actually bigger there than it was this go around last week. You still have a higher Hakinashi close this week, and as of right now, just one day into the week, we have a lower high point. So we'll see how that turns out. Again, it's a smaller body than what we've seen in a while, smaller shadow, than what we've seen in a while so far. And the body remains below its moving average, slightly above it, but again, not pulling this up. Instead of it's still kind of in convergence mode here. Looking at the 3 green arrows, again, we'll see if we have 3 green arrows, which we do on the S&P 500 and the Dow Jones Industrial Average. We do not have 3 green arrows on the Qs or the Russell. The Russell Stochastics is still red, and the MACD is red on the Q. So again, you can kind of see still in quasi-convergence mode here too. That's on the daily chart. If you look at the weekly chart, you can see clear bullish mode across the board here. 3 green arrows. The MACD is dropping. If you look at the weekly on the Russell 2000, this MACD is probably the closest to giving us a red arrow on its weekly chart. So everything else, 3 green arrows, pretty strong 3 green arrow patterns across the board there. Looking at the some of the other oscillators, let's look at the DMI first. You'll see that the DMI, again, it's not too common for the positive indicator to stay above 40. And when it does, it typically coincides with at least a short-term peak. It doesn't mean we have to drop. It just means that the gains start to really slow down. As you saw, we're in convergence mode on the 3 green arrows. We we do need to take a look at that 2-line version here really quick. But with it being above 40, it is interesting. All these other instances that we were above 40, the negative indicator was below 10 there, was below 15 here, was well below 20, it was below 15 there, and was below 10 there. So here we are above 40 this time, but the negative indicator is actually above 20. Again, very, very uncommon to see that. So again, it goes to show just how much like we're just hanging on to this bullish trend, as the negativity, instead of being extremely low, is actually pretty high, the negative indicator here. We did skip that 2-line chart. Let's take a look at this chart here. Again, well above average, and all these lines, they're all moving up. They're all in the right order. The MACD is slightly above its moving average. That's the case for IWM as well. This little rally got us back above the 8-day. It's rising. Everything's rising. The 30 is not back above the 50 yet. It's slightly below it, but they're really close, and they're both rising. And we're well above the 200-day. In fact, I mean, we are very, very far above the 200-day moving average. If you look at SPY, and if I were to take a look at how far above here, the 200-day moving average we are, you can see we're at 12.5%, which, again, in 2021 and even at that parabolic peak in 2020, before that intermediate decline, we were a smidgen above that. In 2021, during the reopening trade, all the way into the beginning of this inflationary spiral that we started, that's about how high we were, above the 200-day, which is now rising. But before that, like 2018's peak was slightly above this level. And that was like a really parabolic peak. Over here, 2013, again in the midst of QE3. And then we had some volatility for about 6 months or so there. And then 2011, we went sideways after being this far above the 200-day moving average. So needless to say, this is a pretty darn high level, and we've now hit it twice in the last 6 months. So 2 very strong parabolic moves in a very short amount of time. It's kept the RSI and the CCI up at high levels. Let's see, here we are, right there. So you're still above 60 on the daily. You're still above 100 at least on the CCI down there. You can see the weekly RSI is still easily above 70, so still very overbought. Your CCI is still diverging there. That's still a pattern that's taken some time to play itself out. Looking at the Ichimoku cloud, the daily chart, again, we are way up here. We're above 18 now. Again, we just keep moving this line up, and it's not really one of the only times that we've had it above 18 was that parabolic peak in 2018, and we went all the way up to 34. But otherwise, 18 is a high number. Like 2006, again, when we came off of the last rate hike in June of 06, we went to the beginning of the year, and then you can see what happened in 2007 and eventually in the 2008. But that was this is a strong level, again, coming off of what is widely expected, which was actually back here in July. Right there was the last rate hike that we ended up having. We did have our correction immediately after that before really taking off as a result of now anticipated rate cuts. We'll talk about more here in just a second. You can see the whole moving average. Here we go. The whole moving average has turned back to being positive. That's a very positive sign. Your parabolic SARs are down below us. That's not the case in the weekly chart. We are still flirting. That parabolic SAR is really close on the downside, though it would take a pretty significant move for it to drop lower. And we are still closing, as of right now, on the Hakinyashi basis above that 20-week hole. So we're not too concerned yet about any kind of reversal, but it is sure getting closer and closer. Those parabolic SARs started out so far below, and then now has been moving up pretty rapidly as we are, again, well up above the 200-day hole, 200-week hole, the 98th percentile of the past 5 years. If I were to go out to the 20 years, we're in about the 75th percentile. Really, the only 2009 was about the only time that we were this far up. We had moved up so fast that we were this far up above that 200-week whole moving average. So very, very sharp move to the upside. If we take a look at the Bollinger Bands and the Keltner channels, you can see the bands continuing to move, kind of trend lower here. We are up against, we did a couple of days ago on Thursday, broke through the upper band again, but now we're back still in the upper quartile, so still positive, still slightly below the upper Keltner channel. So we had gotten up above it. Now we're slightly back below it. That momentum is still very, very strong there. I mean, we've had momentum, positive momentum now for a very long time. It's not common for it to be that long without a bearish momentum. You can kind of see right over here you had some slight bearish momentum, but you had a pretty decently long bullish momentum run. Again, similar to this, except we just never went bearish here. We were bullish for this entire time, and then that's about it. You can see even over here you had a bearish decline in between some bullish runs. This one was probably one of our longer bullish runs of momentum without a bearish move in between. When we had all the red dots, we just turned back to a new bullish move. So you also had that again over here, very long period from October 2019, again with no negative momentum there, and then no negative momentum really here, kind of small, very small negative momentum before that last move higher. So that was a good 3 or 4 months, and again very similar to what we're seeing right now when this started here in November, early November, and now we are through February into almost now March. Probably will be into March before we ever get any kind of red arrow, or for that matter a red dot. Remember, the red dots don't come until your bands are inside, until the band width has come, the band width here, there we go, has come down inside of the Keltner channels. And so we've only really had that once since November. We came really close there, but really this time. So again, that usually precedes any kind of reversal, kind of like this over here. And when you get a reversal, just some bearish momentum, again, that we're just not anywhere close to right now. Looking at the weekly chart, you can see this big gap that people kind of wondering whether or not that's some kind of exhaustion or is it a breakaway gap, even though it's a very, very weak resistance level that you would have broken through there. We kind of followed through on it. We haven't really followed through the rest of the time. Again, very small ranges these last 2 days, so it's not like we're tanking here. We did get a new high last week, so we're at 100. We're working our way back down towards 0 on the low point, so eventually this will most likely hit 0 again. The question is if and when we will fill in this gap. I kind of talked to market scholars last week about the probability, the higher likelihood that we'd fill in this gap sometime this week. At least to the bottom of the gap. Not that we'll break, into the lower half of this chart per se, but at least filling in this gap by sometime this week, and I still expect that to be the case. As I showed you, today's volume and range were extremely low, very, very low. As you can see here, the volume was like a holiday volume, only 50 million shares trading, well below the average. The range was less than 3 points. So it continues to put this chart, at some significant lows, still easily below the 1% mark. And then, like I said, the volume is just trending down to very, very low levels. And the VIX reflects that too. The VIX, which has been higher last week, and started off the day higher today, because the VIX always starts off Mondays higher. But you can see how, let me get to this chart. It did come down by the end of the day, and it's now sitting on that 90% mark, which, remember, when you're above it, that's going to be a support. It was a resistance when you're below it, but now it's a support that we're above it. The VVIX had dropped all the way down to extremely low levels. The VVIX yesterday, on Friday, had dipped its way down to, let's see here, it would be, let's see, that's 8.5 today. It'd be 78, so it did dip it below 80 again. Each one of these other instances where it dipped below 80, the VVIX ramped up. And just to kind of give you an idea, this is what happened. So this dropped below 80. You can see the VIX rallied up to about 15. Dropped below 80, the VIX rallied up to about 14.5. dropped below 80. The VIX rallied up to over 15. Dropped below, this is the highest low point, but still below 80. Now, will the VIX ramp itself? Will it ramp itself up? You expect that will be the case. To have a couple weeks of seasonal bullishness on volatility. The MACD and stochastics obviously down, but reflecting things moving lower. But you can see we're still holding moving averages like we have each of these other instances that the VVIX dropped below 80, where it just dipped its toe below like this 30-day average value before ramping right back up. And again, your 200-day average value is now below 15, easily below 15. So we have converged. That gap between where we're at in this, I mean, we haven't moved anywhere on the VIX since June of last year. The VIX is pretty much the same. When it dropped down at the beginning of June, let's say June 8th, from June 8th to now, the VIX hasn't gone anywhere. I mean, it's been up and down, but it's at the same value. Back then, the 200-day average was up way up here. It was up at over 20, 22, and then now it's below 15. So big change in volatility there. When we take a look at what's driving this price action here, you can see that U.S. equities continue to be the biggest gainer. Up double digits in all three of them, way outpacing their international counterparts, easily outpacing their international counterparts. Again, the three-headed monster, right? Yields down, bonds up, dollar down, commodities down. That's great. That's the bullishness. That's what drives the bullish risk appetite, is those three asset classes working in a favorable way. Today, yields were actually up, commodities were up, but the dollar was down. So we had two of those three-headed monsters, but you kind of need all three to really weigh on risk appetite. The Qs were not up very much, ended up flat on the day. IWM ended up, like I said, up about 0.5%, and then your SPY down. If you take a look at, again, the main three things that we take a look at, like I said, yields were up again today, back above their 8-day, up to about 4.3% by the close. MACD histogram has been declining, but you're still above the moving average. MACD is still above its moving average, as we're still, now the 30 days almost crossed above the 200. You've just really started to trend higher. Commodities, you can see, continue to put in a base here, trying to figure out where its low point is, bouncing back up. Of course, the big factor in that is crude oil. It's been up and down, above and below its 200-day moving average for the past couple of weeks. If it were to break out, say above 79, then now it's probably going to clearly stay above the 200. If it were to break down below, say 75, now things are more bearish. So we're kind of stuck in the middle there, right up and down around that 200-day moving average. And of course, your dollar also has been kind of flirting with its 200-day moving average. Got up above it. It's had a little bit of a pullback here. MACD and stochastics down. And as of right now, still holding it, right? Still holding that 30-day, for that matter, that has just crossed above the 200, as well as holding the 200. So again, bounce back up above this 8-day and 17-day exponential would get us going again to the upside. And probably not what risk would not be bullish for risk appetite if it were to make that pattern there. Of course, we always like to look at the breadth. If we take a look at the breadth here, the new highs and new lows, you'll see probably has not been updated yet. I don't think it has been updated yet for both the NASDAQ Composite and the New York Stock Exchange, which is what this looks at. But at least you are still positive, above the moving average, which is rising. So that's a good sign from a new highs perspective. The number of stocks above the 50-day moving average, however, not so bullish, right? It had gotten above at the end of last week, gotten above its moving average again, which is great. When you get above the moving average, you're bullish. But when you get above the moving average and it fails, you can see it's not bullish, right? It tends to be more bearish to the downside. And so not the best sign to see from a breadth standpoint there. And again, you can see the 200-day had gotten even so far above its moving average that it actually turned it higher. But now has kind of come back down, and we'll see what impact it has. It's made the ratio chart pop back above its moving average. That is also still rising. Again, that's more of a bullish sign from a breadth standpoint. Again, reflecting some of the weakness we see here in the skew. The skew When it breaks its moving average, that typically puts pressure on equities too. It had been above 160. In fact, the average itself got above 150, which is so uncommon. It did back in 2021, but that's the only other time. So the fact that it's got above 150, the average did, and now we are back easily below that average, again suggests that this run here may be running out of gas. At least according to the skew. Now, we did this before over here where there was a batch of volatility, but then we broke above the moving average and went higher, right, to where we are now, and kind of did the same thing. It did actually, when we broke down here, it did move lower. It's just this one time that ended up just being kind of a sideways convergence move rather than an actual breakout move up to the upside. Let's take a look at how the sectors performed. So bear with me 1 second while I bring up that sector comparison chart. We'll just look at today alone. So we'll go to February 26th. Okay, so you can see two of your big three sectors. Discretionary technology did okay. Communication services are really getting dragged down by Google. You'll see here in just a second. Again, yields were up today, so that means that puts pressure on interest rate sensitive areas like utilities and real estate. They ended up being down quite a bit. Energy was up today, which is, again, something that typically outperforms lately when these other cyclical areas not doing so well. So when you look at the 12 grid for the different sectors all put together, remember it's these three at the top that are your Mag 7 names that are in this list. They're still looking really good. Dark green shading, a green line. Really the only things that don't look good are utilities and real estate, and which is not surprising because they're very interest rate sensitive. Everything else is dark green shading and above the line. Looking very positive. Now, when you look at some of the individual names in that list, especially across those three cyclical areas up there, you can see things aren't so bullish, right? Apple has dark green shading and a red line. Google now has dark green shading and a red line. Adobe is bouncing, but it has pink shading and a red line, excuse me. Cisco has dark pink shading and a red line. Tesla is getting a bull tag, so we'll see if that follows through into something more bullish, but has had dark pink shading and a red line here. Everything else, NVIDIA, Amazon, Meta, Broadcom, Netflix, all still holding gains pretty well as they're converging towards their moving average. AMD probably converging toward its moving average the most out of all of these. A little bit on Broadcom as well, but you're still very bullish on NVIDIA after its earnings. They haven't really followed through very much. And then even Meta and Amazon, which also had very strong earnings reactions, are so far holding, not following through a lot, but at least holding those strong gains that it had post earnings, as Microsoft now has light pink shading, right? So it used to be dark green shading and green line. Now it's converged to the point of having light pink shading and a red line. So that brings us to our trade of the day, and it's actually in the healthcare sector, which kind of gets overlooked. But with all that's going on in the Mag 7 names, Cardinal Health being one of the names in that sector, you can see dark green shading and a green line, kind of a breakout pattern here. It had a really good move, actually a really good move pre-earnings, and then came down after. But then just went sideways and then has really broken out over the past few days up to new highs, at least up to a new closing high. It hasn't quite gotten up to a new intraday high there. The near-term line well into the reversal zone, up above the 90th percentile. The intermediate line has crossed above market sentiment, and it's actually crossed above its 60 levels. So it's easily in bullish territory there. And then when you take a look at some of these other indicators that we look at, you can see a nice little bullish pattern. It's been bullish here for quite a while. It's been in a golden cross environment really since the beginning of 2022 when the rest of the market was in correction mode. Cardinal Health did very well and then continued to do well. Not on a relative basis per se. When you look at like this chart over here, Cardinal Health, let's pull up this chart, and then let's look at Cardinal Health relative to the S&P 500. You can see here, let me zoom out so you can see both 2022 and 2023. So while we were in correction mode, it really outperformed all of 2022. And then at the beginning of 2023, a little bit of a decline, and then outpaced for a bit before some weakness at the end of the year. Good, strong end of the year when the whole market was looking positive, and then it's declined. Right, it's been it's been all Magnificent Seven type names. But you notice we have broken through the moving average there. So let me zoom in again. we've broken through the moving average. The ratio has broken through its 50-day moving average, as you have improving conditions. Right, we are in the momentum here is in the upper, is above 100, and then your relative strength is not above 100 yet, but is moving in that direction. You can see that's kind of what we want to see when they both get above 100, is when you have it's leading, especially when it's up above its moving average. So that's the idea that we're hoping for with this breakout, that will continue to sustain that type of move going forward. So what we decided to do here was to do a long call vertical spread for April expiration, now that March is inside of 20 days. So we're outside of 50 days here. So we'll sell the 120, buy the 115. So it gives us a pretty aggressive bull call spread, putting our typical 0.5% at risk, getting about almost 4-to-1 reward to risk ratio. Has to continue to move higher here, so we have to continue to trend up into April above this 120 mark. Remember, that's what we bought, that's what we sold. So this has to get above this 1 standard deviation level. So we'll keep our eyes and see if it continues to outpace to the upside. You can see even here, let me go back to this chart here. Let's look at the weekly version of this, and we'll go to the 5-year weekly chart. Again, this would be the 50-week moving average, which has been above average. We have been outpacing the market on a long-term basis for most of this past couple of years. Again, during the correction and even afterwards, we've maintained some bullishness over long term. Like it did back here late last year, the relative strength line came down to 100, but as of right now, it's kind of holding with some increasing momentum. We might get a new leg higher up to the upside. That would be the expectation on that breakout pattern. A lot of other signals showing up. Obviously, you have 3 green arrows. When you look at like the DMI, this is a classic breakout pattern above 30, below 20, with that ADX rising from really low levels, suggesting how much room it would have to run if it actually did run. You can see well above the Ichimoku cloud. The green line now is crossed above the blue line. You can see we have intermediate trend strength with the trend quality above 2 and your noise balance above 65. Looking at the RSI and the CCI, you can see that we're above 60 on the RSI and well above 200 on the CCI. So very good sign from that perspective. We have been above 100 for a while now. Like we crossed above 100 back here, and we're crossing above 100 again on a new leg higher now. So kind of like what we saw over here. So we'll see how much of a run that has to us. And you can see today breaking up above the upper band and really flirting into the very end of the day with getting above the upper Keltner channel as well. So a good opportunity there. So again, selling that 120, buying the 115, getting a good reward to risk, keeping my risk really low if it does start to pull back. I don't have it's got to move. So if it doesn't move within a few days, especially if it were to get back below its 8-day moving average here relatively quickly, then we can call it good with a smaller loss here. But considering that 8 and 17 are just crossing the 30 and the breakout that we're having here, as long as we probably hold in that gap there and let it keep running, then we can see how much longer this trade will take us there, especially with that breakout in volume as well. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.